In this video we are going to talk about dividend stocks for cash flow. So before starting this video, please like this video and subscribe to this channel for our future updates. Since 1900, stocks have generated annualized returns of approximately 10%, which is significantly higher than the returns generated by other asset types such as bonds, commodities, and bank savings accounts. The S&P Wink with tongue sticking out 500 index gained 28% last year, and returns have been in the double digits for 5 of the past 6 years. When you've had a long winning streak, it's natural to be frightened of getting paid back in kind. Take the difficult start for equities in 2022, and add in Russia's invasion of Ukraine as a geopolitical wildcard, and the result is a tremendous amount of uncertainty, which the market despises. Real estate income. Realty Income, $67.55, pays monthly dividends, making it a solid pick for seniors looking to supplement their income. Realty Income has paid a dividend for 609 consecutive months, making it one of the most consistent dividend payers in the market. There are roughly 6,600 commercial properties owned by the corporation that are leased to 600 tenants across 51 industries, including Walgreens, WBA, FedEx, FDX, and Walmart, WMT. Buildings leased to tenants with investment-grade credit ratings account for over half of Realty Income's total rental revenue. Verizon. The Verizon Communications (VZ) $59.29 company, in contrast to ET and AMP (TT), has recently concentrated on its core wireless business. As a matter of fact, the company restructured its operations in 2018 to better focus on the launch of 5G services, and it just announced a $5 billion deal to sell its AOL and Yahoo holdings to Apollo Global Management (APO). Investing in network quality allows the firm to maintain its position among RootMetric's top-ranked organizations for wireless dependability, speed, and overall performance. As a result of the fact that Verizon services are not optional, the corporation has a high number of subscribers. Universal Health Realty Income Trust. 72 healthcare facilities are owned by Universal Health Realty Income Trust, UHT, $66.33, which has assets in 20 states. More than 70% of its portfolio consists of medical office buildings and clinics, reducing the company's reliance on federal and state healthcare programs and lowering its overall risk profile. UHT, on the other hand, owns hospitals, independent emergency rooms, and child care institutions. Founded in 1986, Universal Health Realty Income Trust began by purchasing properties from Universal Health Services, UHS, and leasing them back to UHS. UHS is still successful today, accounting for approximately 20% of total revenue generated by Universal Health Realty Income Trust. National Retail Properties. NNN, $47.60, which has increased its dividend annually for the past 31 years. Over 10,000 publicly traded firms have boosted dividends for the same time or longer, but just 86 of them have done so. This real estate investment trust has around 3,100 freestanding properties that are leased to over 370 retail tenants, including 7-Eleven, Mr. Car Wash, and Camping World, among others, CWH. Firms such as convenience stores and restaurants, which are resistant to e-commerce, account for only 18.2% of total income. Ennis. It sells labels, checks, envelopes, and presentation folders, among other things. Ennis, the company, which was founded in 1909, now services more than 40,000 global distributors. In an increasingly digital environment, Ennis has carved out a solid niche for itself by customizing 95% of its business items to meet specific customer needs. Aside from that, it is a varied organization, with no single customer accounting for more than 5% of total revenue. Chevron. It's difficult to disagree that Chevron, CVX, $109, is the most well-positioned and most committed oil corporation to continue paying its dividend in these challenging economic conditions. In 2019, the company's net debt-to-capital ratio was 13%, which was much lower than the industry average of 20% to 30%. Chevron conducted a shrewd all-stock acquisition of Noble Energy in order to take advantage of the low oil prices at the time. W.P. Carey. Among the company's holdings are operationally critical commercial real estate, according to W.P. Carey, WPC, $74 per share. W.P. Carey owns more than 1,200 industrial, warehouse, office, and retail properties in the United States and Europe, according to the company. The company's facilities are leased to about 350 long-term tenants, with rent increases included in 95% of all lease agreements. Aspects of W.P. Carey's operations are also well diversified. Around 40% of revenue is generated outside the United States, its top tenant pays only 3% of the rent, and its largest industry exposure, retail outlets, generates approximately 22% of revenue. Pembina Pipeline. Since its initial public offering in 1997, Pembina Pipeline, PBA, $32.23, has paid dividends to shareholders. Transports oil, gas, and natural gas liquids, NGLs, primarily throughout Western Canada. It has been possible for Pembina to maintain steady payouts despite fluctuating energy markets because of its business approach, which is built on long-term fee-for-service contracts. Enbridge. Enbridge, ENB, $39.79, is a pipeline and storage company that owns a network of pipelines and storage facilities that connect North America's major oil and natural gas producing regions. Even if the energy landscape continues to be challenging, ENB is well positioned defensively. ENB is capable of self-funding both its expansion capex needs and its dividends from operating cash flow, eliminating the need to rely on external capital markets, says CFRA analyst Stuart Glickman. Enterprise Products Partners LP. Enterprise Products Partners LP EPD, $23.27, is a large midstream energy corporation with a diversified business model. The corporation owns and operates the pipeline infrastructure, storage facilities, processing plants, and export terminals that it uses for its operations. This MLP has connections to all major shale basins and refineries, assisting in the movement of natural gas liquids, NGLs, crude oil, and natural gas from upstream producers to downstream users. The gross operating margin of the enterprise is obtained from fee-based operations, which reduces the company's susceptibility to fluctuations in energy prices. It also boasts one of the best investment-grade credit ratings in the market, BBB+, as well as a conservative payout ratio. Duke Energy. Duke Energy, DUK, $100.54, offers a dividend that has remained consistent over time. Instead, the regulated utility has paid a cash dividend on its common stock for 95 consecutive years, according to the company's website. On the list of the best recession-proof stocks compiled by Simply Safe Dividends, Duke is included. Approximately 7.8 million retail power customers in 6 Midwestern and Southeastern states are served by the firm. Duke Energy provides electricity to over 1.6 million customers in the Carolinas, Ohio, Kentucky, and Tennessee, according to the company. The majority of these places are well connected to the regulatory system and have a solid demographic base. Pinnacle West Capital Corporation. PNC Capital, PNW, $85.61, is the largest and longest-serving power business in Arizona, with over a century of experience. Approximately half of the energy consumed by the regulated utility is derived from renewable sources. Washington Trust Bancorp. Washington Trust Bancorp is a financial institution based in Washington, D.C., WASH 52.98. Nonetheless, don't be fooled by its diminutive size. Washington Trust is the nation's oldest community bank and the largest state-chartered bank in the state of Rhode Island. Washington Trust also makes a lot of money from wealth management and mortgage banking services, which are in addition to its lending business. Over time, the revenues generated by these enterprises become more consistent. Consolidated Edison. It was created in 1823 and serves 10 million consumers in New York City and the surrounding areas. Consolidated Edison, ED, $77.86, is a utility company based in New York City. The earnings from regulated utility operations account for around 90% of total earnings, assuring predictable returns over time. CONE has increased its payout for 47 consecutive years, thanks to the continued need for energy in New York. Among utilities in the S and AMP wink with tongue sticking out 500, this is the company with the longest streak of yearly dividend increases. Southern Company. The dividends paid by regulated utilities are substantial, and their growth rates are predictable. In many retirement portfolios, utility stocks make up a significant portion of the assets. Since 1948, Southern Company, so $66.05, has been distributing dividends on a regular basis to shareholders. 9 million people live in the Southeast and Illinois, where the corporation does business. Southern has suffered some recent losses as a result of delays and cost overruns on clean coal and nuclear projects, but the company remains financially stable. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.